You've tried everything at this point. Indicators, SMC, ICT, and in the beginning you were trading support and resistance. And yet, you're still unprofitable after years of trading. And if you have just started out trading, then let me save you years of wasted time and money that you will lose along your journey. This is not a regular masterclass like you see on YouTube. This is a negative risk to reward masterclass. There has never been somebody doing this on YouTube and sharing the knowledge that I'm about to give you in here. In this video, I'm going to reveal the secrets on how to become profitable, how I was able to be interviewed by prop firms, countless of payouts, and also why my students are way ahead of the game. Now, as you can see guys, the length of this video is quite high. It's because I've put a lot of effort into this, and I would really appreciate it if you're just going to leave a like and also subscribe to the channel to not miss out on any golden value that I'm giving away in this channel. Now, there's timestamps down below, but if you're serious about trading, then watch the video from start all the way till the end so you don't miss any valuable information. Let's get into it. Alright, so here we are at the masterclass. Now before we're going to start, I want to tell you that there's timestamps in the entire video. So if any point in time you're thinking that you might already know this information, just skip to the part where you think that this is going to be valuable information. Now, but this is the next thing, there is only valuable information in here. This is basically the full blueprint on how to become profitable for any level of trader. Even if you're already advanced and even if you are already profitable, there will be some goodies in here where you can actually take valuable information out from. We will not go over every single topic in here, but just so you get the broad overview. Now we'll talk about why a negative risk reward is better, specific conditions, how do you identify when the market starts to consolidate. Then there's also going to be all of these different concepts like what is liquidity, what actually matters, how do we analyze them, and most importantly, how are we going to put all of these different things together? I'll also give you a custom negative risk reward session that only I know about and nobody else teaches on YouTube, because firstly, nobody's trading negative risk reward, and secondly, I've invented it myself. And at the end of the video, you'll also get a full backtesting session explaining everything from 1 to Z, how to put all of the information that we have learned so far in this entire masterclass, and just basically a full summary on how to put everything together. And also, there is a free Notion template on my website. So if you're just going to click the first link in the description and then just navigate to services, then you will get this little button, free resources. Click on it and you'll get the entire Notion regarding to this entire masterclass basically. And with that being said, let's start with the video. Let's dive into it and make you a profitable trader. Alright, so first things first, we need to understand why trading a low risk reward is better than a high risk reward. If you already know the benefits of this step, then just skip to the next part of the video. All of the timestamps are down below. So understanding why a lower risk reward is better than a higher risk reward is, first of all, everybody's trading a higher risk reward. So you might be saying, well, everybody is doing it, why shouldn't I also do it? Well, simply because everybody is also unprofitable. So if everybody is unprofitable, why should I trade something that nobody's actually profitable with? This is exactly why this image represents very well what I'm trying to tell you here. Everybody's trading a high risk reward, but they're not profitable with it. But there is few of us traders who are actually trading a low risk reward, which that will result into a very high win rate. So if you're going to do this way, what everybody else is doing, you'll not become profitable. But if you're that one guy who's going that lonely path, then you will be profitable because you're not doing what majority is doing. And this is not just me sitting here and telling you that you have to be special and that you have to reinvent the wheel. No, totally not. You basically just have to look at the facts if you don't want to be special for that sense. Because let's look at the facts. Now, if we look at this table, this is a probability how much you're going to lose in a row with a certain win rate. A lot of you traders say that you have a 50% win rate, or let it even be a 60%, right? So firstly, most of y'all, you don't even have a 60% win rate. If you are aiming a 1 for 2, then most of the times you will not have a 60% win rate. I said it earlier and I will repeat myself over and over again until you traders understand this. But let's just say you are the anomaly. Out of everybody who's watching this video right now, you are the anomaly and you have figured it out how to have a 60% win rate with a 1 for 2. Well, then let's just look at the facts. So you are going to eventually lose 5 times in a row, inevitable. Now, more likely you'll actually lose 6 times in a row at some point, because this is not even that unlikely. With a 60% win rate, you will lose 6 times in a row. Simply, if you're going to trade for a longer period of time, this is only 50 trades. But if you're going to extend this for 100 trades, 200, 300, 400 over 1 year of trading, or even 2 years of a backtest, then eventually you will even have losing streaks going 7 or even 8 times in a row. This will eventually happen. This is just how probabilities work. Now, this is just the absolute best scenario that we are talking in right now. You don't have this high of a win rate because you're trading a high risk reward. So more likely, you probably have a 30% win rate. Now, with a 30% win rate, you are not even safe of 10 losses in a row. Can you imagine that? So the probability of you losing that many times in a row is almost 100% after 50 trades. Now, of course, with a 60% win rate, it's less likely that you are going to lose that many times. But trust me, 37% is not that unlikely. You will get eventually into that kind of losing streak. Well, now you might be saying, well, I'm losing. Losing is part of trading. Yes, losing is part of trading. However, what does losing lead to? It leads to bad decisions and a bad psychology. Once again, you're doing what the 90% of people are doing, so you get the 90% of results. And this makes you outcome independent. If you're taking loss after loss, then you are putting way too much weight into it, because almost no human being, after losing 5 times in a row, will still stay disciplined and not going to revenge trade or anything like that. So you have to ask yourself, after losing 5 times in a row, will you change something with your system, or will you just simply stick to it? This is the question that I'm asking you here. Probably not, or else you would have already been profitable with what you are already doing. But there's actually even more to it. So if we're going to look at it from this perspective, having a 50% win rate, we have already identified that it's most likely inevitable to not lose 6 times in a row with this kind of a win rate. So if you're going to start the year from 2026 and you will trade, you'll see some gains. Of course, you cannot win every single trade. You'll have a bit of a break-even phase, break through that, go higher and higher. But remember what we have just talked about. 6 losses in a row will eventually happen if you're going to take 100 trades within the year. 100 trades within a year is definitely possible. So 1 loss, another loss, another loss. This is the 4th loss, this is the 5th loss, and this is the 6th loss, okay? And then from here on, if you are profitable, then yes, you will climb this back up. And by the end of the year, you will land at a net profit, okay? However, the problem is that even if you land at a net profit by the end of the year, that means that this entire period, you have not made a single dime off of trading. This is what you don't understand. So basically the drawdown period, how long will I be not making any money out of trading until I'll eventually get over that high watermark? Now the high watermark is the highest point your equity curve was ever in. So in this point of time, it wasn't here. And traders don't understand this, that this entire period was at least 3 months of just you not making any money. Put that into a perspective. This is not just a couple of days being a drawdown. This is multiple months where you have not seen a single profit payout. You were not able to withdraw from your personal account. You basically couldn't do anything. But let's compare it with a low risk reward that will ensure that you have a very high win rate, which is going to be 95% in my case. Even just losing 2 times in a row is so unlikely that most of the times it won't even happen. However, it can happen because it's still 10%. Now, losing 3 times in a row with a 95% win rate is a territory where you might as well just play the lottery, because this is not going to happen. It's too unlikely. So remember how the guy that had a 50% win rate landed somewhere in here with his P&L. Now we're going to flip it a little bit and we're going to put it at a 95% win rate. So now you have a 95% win rate and you're just trading from 2026 all the way to 2027. So how your equity curve is going to look like, it will go steady higher and higher and higher and higher, right? You're going to basically win every single day. Yes, you'll have a losing day. That happens. Climb it back up, right? Slowly, a loss. And then eventually you'll just climb up very steady. You see how professional this equity curve looks? Even if you're going to go into a drawdown again, loss, no problem, climb back up. And over. So over the entire year, you'll barely even take 10 losses. Most likely, this will even be way lower. You will not take that many losses with this high of a win rate. Now, there's a big difference. The guy who had a 50% win rate, his chart was looking something like this, remember? Now, he was landing at a higher profit. However, at what cost? At what cost was he landing at a higher profit? But he had to pay a very big cost of landing in a big profit. He was not making any money for 3 months. However, the guy that has a lower risk reward and a high win rate, he was making money every single month consistently. So what is better, making consistently money or by the end of the year more money? Now, you might be saying, well, I will just stick to the strategy and then I'll make more money than the lower risk reward guy. But there's a big problem. You will not stick to the strategy simply because it's getting on your psychology that hard. However, in this video, I'll also show you ways how a low risk reward trader will also make just as much money as a high risk reward trader while still not having to sacrifice 3 months of unprofitability. Now, in the last point, why I would give it a try if I would be sitting in your shoes is, man, you have tried everything except a low risk reward. So you have tried everything possible to become a profitable trader. All of these stupid ways to make a lot of money, and yet you're still unprofitable. So why aren't you just testing it out? So let's start with the actual points on how to master a negative risk to reward. Now we need to talk about specific conditions, and if you don't understand which condition to trade a negative risk to reward, then no matter how good the strategy is, it is not going to work. Now the market has a couple of different phases. I will not tell you in this video what an uptrend or downtrend is, simple as that. Uptrending is when it's going higher, and downtrend is when it's going lower. However, what a low risk reward trader focuses on is a consolidation phase. Now, but you actually need to understand why is it so important trading a consolidation phase. Now put that into your notebook. Trading a low risk reward in a consolidation phase will most of the time always land you at a win. Now, and here's the reason for that. If we're just going to look at the charts, and we want to look out for any consolidation phase that has previously happened in the chart. So basically in here, right, you can see the price is not going anywhere. It is just in the small little area, and it's really not going higher, but also not lower. Of course, eventually every single market phase, whether it's going to be an uptrend or downtrend, we will also go at some point lower or higher. But in this case, let's just only focus on a consolidation. So this was on the daily chart, and now we are at the 4-hour chart. Simple as that. Now, if you are going to take a high risk reward, which you have been told that a consolidation is bad, and this is one of those points where I don't even disagree with people who say that, because it's actually true. Trading a higher risk reward in a consolidation phase is basically a nightmare. You will definitely lose. But why is it so good in a negative risk reward? It's because you're giving the trade way more room to breathe. Now look at it this way. If you have a trade like that, and even if the trade is going into a drawdown, so let's just say you entered somewhere in here. Of course, if you are going to enter at the worst possible price, then even that will also get you into a loss. But I'll also show you how to mitigate those types of scenarios. But firstly, if you are going to take these kinds of trades, you see that no matter how much you are going into a drawdown, it will still end up in a win. And this goes for basically anywhere in the chart. Look at it from a different perspective. No matter where we are going to take a trade, we'll most likely still end up in a take profit, simply because you're giving the price action so much room. Even if it goes into a drawdown, it will still end up in a take profit because it's just going sideways. You cannot lose in these kinds of conditions unless you're doing something very wrong. But there's one more reason what differentiates the profitable trader from the unprofitable trader, and why a consolidation phase is always better for a negative risk reward trader. Now we have to firstly understand that the entire market consists of just two things. So let's just take this as an example. We definitely are in an uptrend, but we also have pullbacks. Now, the problem here is that if you're going to trade a high risk reward, even if you're right on the direction, so you know that it's an uptrend, you also have to predict the time aspect of trading. So see, you were right on the entire trade. However, if you're not going to be able to time it well, you'll be stopped out. If you're just going to take it one candle too late or too early, you'll be stopped out. You have to take it at the right moment in time, so basically right in here, just so you can actually get a profitable trade. Now, and in practice, so basically in the real markets, this will be looking something like this. So you have some kind of low identified, it has traded into it, and from here on you want to basically long into a different point of interest. Now, what happens a lot of times is that you are actually right on the trade. It goes into the trade for a little bit, but then eventually you will just see it's just going to go into a drawdown, and from here on you will just be stopped out. But what happens afterwards, this is the interesting part. The trade just simply continues into your actual take profit. Now this has happened to you a lot of the times, and you'll be like, how's that possible? Did I really got stop hunted? Is the price really looking out for my stop loss? No matter or not this is actually the case, it doesn't matter. Matter of fact, we only care about the facts. And the fact is that you have seen this 1,000 times and this has not worked for you. It's because once again, you had to predict from which point on is it going to go up, which was right in here. With a low risk reward, this will not happen. Even if you're going to enter in here and your stop loss is wide enough, based on analysis, which we'll also get into later, then you'll still end up in a take profit, simply because you're giving the price enough room to breathe. So now you might be saying, you have taught us what the ideal market conditions are for a negative risk reward trader. But how do we know when ideal market conditions are going to start? There's basically two methods to do this. Now, the first method is going to be trade a market which is already consolidating, and this is also the easier method that you can go for. Now, especially if you are a beginner into a negative risk to reward, just go over a bunch of different pairs. I've linked them down below in the PDF that is actually free for you to use, and you'll see a bunch of different pairs which are already consolidating for months or even years at this point. It's definitely the easier choice, especially if you are a beginner negative risk to reward trader. Now, and the second method is, the longer a trade continues, the more likely it becomes that it's just going to stop. Now, and this is actually a pretty interesting case study. Now, as you can see, we are just trading lower and lower and lower. We are basically just having a downtrend for that matter. Now, of course, we have some kind of consolidation going on in here, but we don't really care about that for now. But there's something that you really have to look out for. Every time that we are reaching a bottom, we start to consolidate for at least a little bit. Every time we are going to hit some kind of bottom, we also start to consolidate. So you don't even have to look out for something that goes months and months on consolidation phase. Of course, you would want to have that because this pair has been consolidating for multiple months on end. However, this is not even needed, and you can really just go on for very small price movements within the internal trend. How do I know from which point on the price action will just start consolidate, and then from here on I can just have a lot of trades which are all going to be wins? Now, firstly, of course, you cannot be exactly precise when it's going to start doing a consolidation phase. However, there's a lot of different indicators which we'll get into very shortly, which I'm going to teach you how to identify them. Before that, understand a very simple concept. If you are going to go back into the chart and you see that price is starting to get weaker, what do I mean by weaker? It's just starting to create large wicks and not really going anywhere. Just go and actually trade that condition. Simply because if you have 5 candles which are just starting as a consolidation phase, start trading. I don't want you to start taking a trade just because you see one big candle that has a wick. Don't do that. You need to have a couple of candles that are just consolidating on the daily chart, and then from here on you have already a confirmed consolidation. Now guys, quickly, no matter how good as a trader you are, you always will need a journal to back off your data. That's why I personally use TradeLens. TradeLens is by far the best journal that I have ever seen. Forget about TradeSell, forget about everything else you have heard so far. This is the only journal that you will ever need, as I'm using it myself, and I would never recommend to you something that I'm not using myself. So if you want a 10% discount on every single purchase, the link is in the description down below. So I have just explained to you that a consolidation phase is great to use in a lower risk to reward. However, that doesn't mean that you're only supposed to trade consolidation phases. You also can trade when the market is trending or clearly going into one specific direction, which is basically what I like to call established movement. Now, established movement is not your regular uptrend or downtrend. It's something way more simple and way more effective in that sense. So first of all, what is established movement to begin with? Now, if you have candles like this is on the daily chart, by the way, where do you expect the next candle to go? Are we going for the previous day low, or are we going for the previous day high? If you're going to look at this candle like this, just take a guess. Of course, we will go for the previous day low and not for the high. So if you're just going to see these 3 candles like that, where do you expect the price to go? Now just take a guess out of seeing these 3 candles. If you have set to the downside, then you are actually right, because of course we will go to the downside and not to the upside. And this is basically what established movement is. You don't need to have an entire uptrend trending higher or an entire downtrend going lower and lower. All you really need is a couple of candles in the same direction, and then you can already confidently say that, okay, we have established movement going on to the downside. Now from here on, once again, where are we more likely to go? We have already established movement onto the downside, so what's more likely to happen? That we will completely reverse all the way higher in here and ignore the low, or will we just go lower because we are already going lower? Simple as that. And of course, we will go lower because we have established movement onto the downside. And once again, we did go for the previous day low and not for the high. Simple as that, because we have established movement, and this goes for any time frame. Now the next candle is going to be a little bit more surprising. But as always, where do we want to go? For the low or for the high of this candle? And as you can see in here, we did actually go for the low of that candle. However, how is that candle currently looking like? So we have rejected off of this entire candle. So maybe on the left there was some kind of major draw on liquidity which we have tapped into, and from here on we are going to reverse. However, can you really tell if we're going for the high or for the low? Now, safe to say we will go for the high simply because we have rejected off of something. However, that is not established movement onto the upside yet, because we need to see a little bit more. So we would completely ignore this candle and wait for the next one. We would not trade the candle that is about to open in here. So this is going to be the next candle. Is this established movement onto the upside to you? Well, to me it isn't, because this is not established movement, because you only have two candles which are not having any strong momentum to them. So as a general thing, you like to have a lot of movement onto one direction and not just a little bit of movement into one direction for that sense. So this is going to be the next candle. And in this candle, there's actually a very small detail that you don't have to overlook, because if you will overlook these details, then it will cost you a loss. First of all, what have we done? We have gone for the previous candle high, but also for the previous candle low. This is indicating a lot. Usually that does not happen, and that's more of a rare occurrence. So if we would not avoid these kinds of candles, then this would have been a straight loss. But from here on, things are looking way more probable, because where are we going to go? For the previous candle high or for the previous candle low? Now this in here, this is already established movement onto the upside, because you have three candles into the same direction, but also a very big move onto the upside. So if we had three candles just looking something like this, so let's just say the next candle will be looking something like this, then this would not be established movement, because you need to have momentum behind the candle. So of course we will go for the high of that candle and not for the low. And this will pretty much work on every single time frame and almost every single time. That's what I like to call, once again, the established movement. You don't really care about the trend, you mostly only care about the current situation of the market. So once again, previous candle high or low, by now it should be pretty obvious. We have gone for the high of the candle, and from here on, this is a 50-50 candle, and you can't really tell. And from here on, you would basically repeat the same thing that we have done over here, waiting it out, waiting for one big move, and then from here on you can still continue trading. So let's go over a couple of examples so you really understand how to identify established movement. This will be extremely important when I'm going to explain to you how to identify the bias, because this concept is essential to learning the daily bias. But not just the daily bias, but this goes for every single time frame that you're going to trade with my strategy. So first of all, where are we going? This is probably for the high. We have already established movement onto the upside, so we're going for the high of this candle. Yes, this has happened. From here on, where are we more likely to go? Now in this example, I already know that we will go for the previous day low, simply because there is a bunch of different concepts which I'm going to teach you later in this video. However, for now, we only care about this simple concept. Keep it very simple, guys. Established movement. Do we have established movement onto the downside? No. So we're not going to trade the next candle and wait it out. We have gone for the low. From now on, we still don't know. We have no established movement onto the downside or upside. So continuing until we have more of a big move. Still, this is not a big move. We don't really care about it. So we're going to skip it. From here on, this is what I like to call established movement. Not just because of this candle, but because we have this big candle, but also this entire price action move. So what has happened? Let's analyze it step by step. We have gone onto the upside. Granted, okay. But what have we done afterwards? We are just consolidating in this little bit of price action. So what does that tell us? Basically, that the market is getting weaker and weaker. So we are not having willingness to go higher and higher. So what is more likely to happen? We're going to go to the downside of this candle. And this is exactly what has happened. So I hope you really get the point of established movement onto the up or downside. So after we have understood the established movement, so this is the last point that we will talk about before we're actually going to get into all the different concepts that I'm using. So I've almost made it, just stick with me on this one. You have to avoid losses at all costs. Now I know that with a negative risk reward, you would more likely to think that, okay, we're just going to take a couple of different trades a day, and then from there on, we have a lot of profits made, and even if we are going to lose, we have won so much that we are in a net profit. However, losing in a negative risk reward is more punishing than actually winning. Now, even if you have a 50-50 day, because if you look at it this way, so each of these trades represents 0.33 RR. So if you win 3 times, you have basically made 1 RR. So we have won all of these different trades, but just losing one of them will of course wipe out all of these different trades. Now we have already talked about this a couple of times, that even if this happens, we will still end up in a net profit. But what I want you to get closer to is really avoiding every single loss. The up following concepts that I'm going to teach you right now Whenever you are not sure, or whenever you are not by 90% sure that this trade is a higher probability trade, then just don't trade it. We are only taking higher probability setups with this strategy. Take this into your notes, take a screenshot or just write it down. So this is going to be the golden rule of a negative risk reward. It's always better missing out on a trade that would have ended up in a take profit than risking losing that day. Winning will get you a small step further, but losing a big step backward. So let's understand liquidity. Now this is not going to be a regular, okay, stop losses above certain highs and lows and therefore the market is going there. This will get more advanced pretty quickly, but for now we have to go over the basics real quick. Now firstly, what is liquidity to begin with? It's where a lot of different stop losses reside over highs and lows. Yes, you have heard that a couple of times, but there's actually more to it and I trade it differently compared to the SMC and ICT gurus out there. So first of all, why are you able to trade from home to begin with? Because big institutions are providing you the liquidity. If there is somebody winning a trade, then on the other end of the world, there was somebody actually losing. If there is somebody taking from the market, there has to be someone that is giving. So, but how do we actually identify where stop losses reside in the markets? It's basically just psychological levels where it's just most likely and obvious that traders will put their stop loss, such as in these relative equal highs. Because what does a regular retail trader see this as? He sees this as resistance, because the regular retail trader thinks that we will just go trade higher, stop right at the resistance and then just trade lower. Now of course this happens sometimes, but most of the times this does not happen. What in reality happens is that a lot of different stop losses reside over these levels in order to fill out large orders, because they are not trading with small lot sizes like you and me, because to the lot sizes that you and me are trading, this is not comparable to big institutions. So a lot of times what will actually happen is that these relative equal highs, so I'm going to remove this resistance because those are relative equal highs. We'll go over that very shortly what that is. Those relative equal highs will be taken out, and then from here on you'll basically just go over more analysis and find reasons where the price is going to go next. So that's basically the understanding of liquidity. So we are not seeing liquidity as something that we'd like to trade away from, but something that we'd like to trade into, because this is a strong magnet to the upside. So we have arrived at the previous day X, which is basically the previous day high or previous day low. So how are we actually going to identify the daily bias? And this is the very first step that you want to do every time you're going to take a trade. Before you're going to go lower into the 4 or 15 minute, 1 or 5 minute, you always want to start at the daily chart, because this is going to get you a direction for the entire day. Remember guys, we are day traders and we are not position traders, because position traders are taking trades that go over multiple years. So ideally, the day you got into the trade, that's the same day that you want to get out of the trade. This is exactly why I wanted to show you established movement onto the up or downside first, so we can further understand the daily bias. Now we will not go over, now in the end we will combine all of the different concepts that I'm going to teach you, and then from there on we're also going to do a little bit of back testing. So from here on, where are you more likely to go? Previous day high or previous day low? This is all on the daily chart and you don't want to go onto the 4 hour for now. Of course, we'll go for the previous day high and not for the low. Okay, we have actually done that. However, once again, we have established move onto the upside, but we can't really tell out of this candle alone. But this is where established movement holds a lot of weight, and it can actually determine whether or not your bias is going to be bullish or bearish. Since we have a lot of established movement, it is still okay trading onto the upside. So we are looking for the previous day high. So this is one of those cases where most likely you'll be saying we'll go for the previous day high and not for the previous day low. And your argument for that would be, well, we have a lot of established movement onto the upside, and also the daily candle is just looking bullish. However, there's a big problem in just looking at it this way. Simply because this candle is what I like to call a 50-50 candle. Write that down in your notes. A 50-50 candle. Now a prime example of 50-50 candles are price action like this. You don't really know where the price is going to go next. A lot of the times when the price action on the daily chart has big wicks and you can't really tell whether we're going for the high or low, then there's a 50-50 candle. So this once again is a 50-50 candle, and we can't really tell if we're going for the high or the low. And even if you can tell, still don't take these kinds of days. So we're going to skip on to the next one. And this is a prime example where this would have been a loss if you would have traded like that. So from the next day, where is it more likely that we will go? For the previous day low or for the previous day high? Now you might be saying, well, we have established move onto the upside, but look at the difference between this entire candle, so from here all the way down in here, and this entire price action move. So this candle single-handedly took out 1, 2, 3, 4, 5 bullish candles on its own. So this is already established move onto the downside, where we're more likely to go for the low or for the high. Of course, it will be going for the low. Now, there's also days where it just takes a little bit of more time until we will actually get lower. However, with a negative risk reward, since your stop loss is very high, you will not be stopped out in these kinds of days. So if you go to a random point in chart, and you'll see that quickly you will actually be able to predict this very well. Are we going for the high or for the low? Probably for the high, because this candle shows willingness to go higher, and there's also liquidity residing up in here, which we'll get into shortly. So this is exactly what has happened. We have gone to the upside, and the next candle is also going to go for the upside, simply because we are just so close to the previous day high. This is also what happened. Now, a very common question is that, well, but this entire candle was bearish. Now you might be saying, well, you are wrong on the bias. No, because identifying the bias, what really counts is if you have predicted that we'll go for the previous day high or previous day low first. This narrows it down for any sort of errors to happen really quickly, because it's basically 50-50. Either you were right that we'll go for the high or low, or you were wrong. So it's a 50-50 every single time. But identifying if the candle will firstly go up, then down, then up, and then it will somewhere land in the middle, this is very hard. So predicting the timing of the market is very hard. We only care about predicting where price is going to go. So on to the next concept, which is actually the very best concept they can ever trade. And I'm using it in every single live trade that I'm taking, which basically stands for relative equal highs or lows. Now that's going to be the golden concept, and I use it in every single one of my trades. So what are relative equal highs to begin with? It's when you have two swing highs, or at least two swing highs, being relatively equal close to each other. Now if you're going to zoom in real quick, you can see that this high is very close to this high, but the second high has also not taken out its previous high. This is very important. If you're going to extend it, you can actually see that there's another high which is also very close to this line that we have drawn out. So this is going to be triple relative equal highs. 1, 2, 3. Why does this matter? Once again, because a lot of people think that this is going to be resistance and we're just going to trade lower from here. But what people find to see is that this is the complete opposite. We're just going to trade higher simply because those are relative equal highs and not resistance. This is basically the single best magnet that you can use for price to go into any direction. Now, and of course vice versa, as everything that I'm teaching in this video, this will also count for the opposite side. We have relative equal lows in here, so where are we more likely to go? Probably to the downside, because this is a magnet to go lower. But now you might be saying, well, but when do I actually know when is that going to happen? Now that's why you're trading in negative risk reward and why your stop loss is going to be quite high. However, that doesn't mean that we're completely ignoring the timing aspect of trading. What have I told you earlier? You want established movement. So this entire candle is basically engulfing the previous candle. So that is an indication that most likely we are starting to go lower. But this is still not enough, as we need more established movement onto the downside. So from here on, this is already a better standpoint. Now you might be saying, well, but how? Because we have not traded into the previous candle low. It's because if you look at a different perspective, these are also relative equal lows. Now how is that? If you are going to go into a lower time frame, now it doesn't even matter what that time frame currently is. This can be the daily 4 hour. If it's the 4 hour, you'll go into the 1 hour. If it's the daily, you'll go to the 4 hour. If it's the weekly, you'll go to a daily. So on a lower time frame, these are actually going to be relative equal lows. So we have already two indications or two relative equal lows that we would like to trade into. So from here on, you could already be ready taking a trade. And as you can see, we have traded into the first relative equal lows. So now we have a 50-50 candle, but this doesn't mean that you cannot trade lower into the major relative equal lows. So this is our major relative equal lows, and these are the small relative equal lows. So since these relative equal lows are so strong, we're just going to take another trade on this exact candle, and we can just trade lower and lower. Now the reason why price went way lower than the relative equal lows, we'll also get into shortly. This is a very big point. The more relative equal lows, so basically a chain of a bunch of different swing lows you have, the better quality it gets. If you're going to actually count them out, you have 1, 2, 3, 4, 5, 6 different swing lows that are contributing to the relative equal lows. this is a major sign that we need to go to the downside. Alright, so let's actually skip forward. So from here on, I'm going to explain to you the FVGs and how they act as magnets. Now we will skip this entire price action point, even though this entire price action move that we're going to go to the downside can already be identified with the relative equal highs and lows concept and also established movement that I've shown you earlier. However, we need to find even more confluences why we will go lower. Now first of all, what do most people do? They mark at an FVG, and then from here on, you have seen previously that chart went lower, and from here on, what would you like to see the chart to do from here on? Probably maybe to go for these relative equal highs, or just trade higher to begin with, because FVGs are supposed to act as support and resistance, right? No, not really, because I like to trade FVGs as magnets. So instead of trading away from them, you want to trade into the FVGs, because if we're going to skip onto the chart anywhere basically, look out for any FVGs that you can see. Price always returns back into them. We have an FVG in here, trade it into it. We have an FVG in here, a very small one, but we have traded into it. A very small FVG, another FVG in here, we have also traded into it. And this goes over and over again. Rarely you will find FVGs that have not been traded into. Now, of course, like any other concept that I'm teaching in here, this is not going to work on its own every single time. There will also be FVGs that have not been filled yet, but most of the times this is not going to be the case. So going back to our example in here, where's price more likely to go? Of course for the FVG. Now if we're going to skip forward, because this is basically another confirmation, another confluence why the price should go lower and not higher. Now we have traded into this entire FVG. Now from here on, what would you say is price going to do next? Now there's a couple of options here. You could say that, well, we have some kind of levels in here, maybe a supply and demand zone. We don't do none of that kind of stuff. We're making it very simple and we don't really care about the traditional ways of trading. Now in these kinds of examples, it's very important that you understand that this entire FVG does not count as confluence anymore, because we've already traded into it. This FVG does not hold any more weight. But like in almost every single concept, there will also be niche examples and niche scenarios, like in this one. So we have an FVG in here, but also established movement onto the upside. Now again, the reason why I'm not showing time frames in here is because this is time frame independent. It works on every single time frame, and once we're going to get into the actual backtesting trades, I will actually show you the time frames. So from here on, where is it more likely to go? Of course for the high of that candle. So we are trading into it. So the next candle has already gone for the high, and I'll be saying, well, the FVG is not useful anymore. Now I think about FVGs, and especially this niche concept to begin with, is that if you have a very large FVG, which you probably cannot compare to the rest of the chart, as you can only see this picture, but this FVG is actually massive, and it's a very volatile price action move to begin with. And the thing is with these FVGs, that we like to completely fill them out. Now there is a difference between violating in FVGs. It's when we are just touching the tip of it, either the low or the high, and then the business is already done with the specific FVG. However, in these cases, you completely like to fill them out. So price would have to go all the way higher in here to fill out this entire FVG, and then from here on, the business is done. Now, like in everything, this will not happen immediately. This will also take time a little bit and a couple of candles until it actually happens. So as you can see, this candle was responsible after filling out the entire FVG, and then from here on, this does not count as confirmation anymore. Now, and we have already arrived at the premium to discount range, or also named as PD array for some. Now, I will give you a quick examples just so you're going to understand it in a better way, and then we'll get into it in a trading sort of topic in that sense, right? So first of all, when you're going to buy something, it can be anything, whether it's going to be at the supermarket or you just want to buy, let's just say, a laptop. Now, if you want to buy a laptop, you want to buy it at the lowest price possible, right? So basically at a discounted range. You don't want to buy it at a very high price, logically. However, the guy that is selling you the laptop wants to sell it to you at the highest price possible, because after all, he wants to make the most amount of money possible. So that is basically premium to discount in a nutshell. Now, what that means in a price sort of things is that when the chart, let's just say we're in a downtrend currently, goes lower, and you want to short this market, then there's a couple of options that you can go from here. Either you're going to find some kind of concept that I've just taught you, like the FVG, that you're going to trade into and then lower, or basically just trade into it. This is what we will also get very shortly into. Now, a premium to discount is essentially just telling your ranges of where you're allowed to short or long for that matter. So if you have price action like this, you would not like to take some kind of POI. POI stands for point of interest in a discounted range. Because if you're shorting, you want to short at the highest point possible and then just go lower. If you're going to short in discount, then you're probably getting a very bad price. And price will also actually return into you and might as well just take your stop loss. Now this will matter on context like all things. However, as a general rule of thumb, if you're shorting, you want to take something in a premium range. If you're longing, you want to take some kind of point of interest in a discounted range. This is basically what a premium to discount thing means in a nutshell. However, there's a little bit more into it. Now the line between the premium and the discount is called the equilibrium, which is basically the center. It's right in between the premium and the discount. What that is essentially that price always likes to return back into the equilibrium. There has never been a point in time or a scenario where the price has not returned into an equilibrium at some point. Now we'll get over this in a couple of examples on the chart now. Now the way you're going to do this is basically draw out the Fibonacci tool. You have to readjust in settings, do it real quick, and then you'll have basically this kind of Fibonacci on your chart. And this goes for every single swing low and swing high. That's how you're going to draw it basically. And price will always return back into the equilibrium. Now remember what I've said earlier. Price always returns into the equilibrium. Now, but you might be saying that you have also seen scenarios like this, where you have picked up a random swing high and a random swing low, and price has not traded into the equilibrium. And this is what a lot of people get wrong, and there's a reason why equilibrium is not working for them. Because you always have to readjust your equilibrium every single time that a break of structure happens. So this was a break of structure, so we have to readjust our Fibonacci. This was a break of structure, so you have to readjust your Fibonacci. And would you look at that? We have hit the actual equilibrium. Now you might be saying, well, if you have to reprint the entire FVG every single time, then you'll just miss trades and eventually your stop loss will be hit. Now, first of all, you are trading a negative risk reward, so you are already giving the trade enough room to breathe. That's the first thing. But the second thing is also, if you're going to take it at a random point in time, then of course it's not going to work. With all of these concepts, I've said it previously, they are not going to work on their own. This will always be context dependent. And I'll get into that very shortly, how to identify the right context conditions. But just as a general example, go anywhere in the chart and look out for it. But just as a general thing, look out for it yourself. Price always returns into the equilibrium, and this on its own is already very strong information, because that is basically telling us the longer a trend keeps on continuing, the more likely it becomes that eventually it has to get half of the point of the swing high and the swing low. Now, as I said previously, if you are shorting, you want to look out for some kind of point of interest to short from. So this can be either an FVG. Yes, we have said that FVGs like to be traded as magnets, not as support and resistance, but that doesn't mean that it's going to count as every single trade in that scenario. This will always depend on context. Sometimes a trade can also go into an FVG, and if the context aligns very well, so let's just say we have relative equal lows in here, then most likely we will actually continue lower and this FVG actually matters. But this doesn't only count for an FVG. Those can be relative equal highs, for example. You're just going to short from the relative equal highs all the way lower in here. Now, there's a positive risk reward. We're not doing that, of course. You're only going to take very small movements with this, and your stop loss eventually way higher. So with everything that I'm teaching in this entire masterclass, you always want to trade at the MOS session. Now, what is the MOS session and when does it start? Now, the MOS session basically starts from 0 all the way to 1 a.m. Now, you can also extend it to 2 a.m., but most of the times this is really just a 1 hour window where you would like to take your setups. Now, there's a couple of key rules that you have to include when trading this session. First of all, if your objective has not been hit, so either that's going to be the previous day low as an example, if it has not been hit within this time window, then most of the times you'll not enter the trade anymore. Same goes if your limit order, so let's just say your limit order somewhere in here, did not get hit before the MOS session has been closed, then most of the time you always want to close the trade, and there's not going to be a trade idea for the entire day for that matter. right? You would have to wait for the next opportunity, which is going to be the next day, if there's going to be one to begin with. And that is basically it for the MOS session. It's very easy, very straightforward, from 0 to 1 AM. That is basically all that matters. However, most of the times you will take your entries right at 0 AM candle, or also known as the 11 PM closure candle. So that being said, that is basically the MOS session. Now quickly guys, I've seen a lot of you guys having problems passing profit challenges with this sort of system. The reason for that is because we're looking for steady growth over time and not looking for that 10-hour R trade. And in the case where I don't pass, you'll not only get the money back that you have paid me, but you'll also get the money back that you have paid the prop firm in order to get the challenge. If that sounds good to you, it's on my website, link in the description down below. So, and we have arrived at the context. Now, I've told you earlier that if you're just going to trade this, like all of these different concepts, the relative equal highs, the previous day high, the FVG, and also the PD range, this is not going to work just on its own. If you're just going to take any of these concepts and just going to trade them on their own, then this is not going to work, because otherwise it would be a little bit too easy. Now don't get me wrong, this is actually pretty easy once you just get the hang of it, but you will just see how you're going to combine all of these different concepts together to not just trade blindly in that sense. Now first of all, what have I told you on the daily chart? You want to look out for, are we going for the previous day low or for the previous day high? And on this candle, some of you guys would say that this is going to be a 50-50 candle, as I have previously mentioned. That's not really going to be the case. Why is that? Once again, it's context. Now, if this candle would just be like that, without any further information, then yes, this would be a 50-50 candle, and you would likely just want to skip on to the next day and look out for the next one and see how this is going to look like. However, what do we have? We have relative equal lows. Now, you might be saying, how is that? You have told us that relative equal lows are identified if you have two swing lows being relatively equal close to each other. Yes, this is the case, but it's a little bit more advanced, and this comes with experience. This low is going to be a swing low on the 4-hour chart or 1-hour chart, because currently we are on the daily chart. So this is essentially all that we want to have on a daily chart, except that also, if you have paid attention earlier, we've established movement. And guys, if you have skipped all the way to this point in time, I highly recommend to you skipping backwards, because if you don't get the knowledge that I've explained to you earlier, then you will not understand a lot of these terms that I'm using. So we've established movement onto the downside. So where's the price more likely to go? For the previous day high or for the previous day low? If you have said that it's going to be the previous day low, then you are right. If it's the previous day high, then you were wrong. So from here, we're going to drop down onto the 4-hour time frame and look for more information. Now, do we have things that are also speaking against the trade? Because this is a very big thing. You not just only want to go for things that are speaking for your trade, you also want to look out for things that are speaking against your trade. Because if you are just looking out for things on why the price should go lower, then you'll be basically blinded by the market, and this is going to be a stop loss hit is that. Now, can we spot more things that are suggesting that we'll go onto the upside? If we had relative equal highs in here, then this would be a reason why we would like price to see to go back higher at some point. But we don't have any of these kinds of indications, and we're just making it very simple like that. We have relative equal lows and also the previous day low. So most likely we'll go onto the downside. So now we're going to drop down onto the 1-hour time frame, which is most of the time going to be your execution. Ideally, you like to have some kind of protection point that the trade has fallen back into before actually creating the previous day low. What do I mean by that? As you can see, we have this FVG, which price has traded back into. This is indicating to us that this low, or this high I mean, is not going to be taken out. And even if it is going to be taken out, we are still giving the trade way more than enough room to actually play out. So in this case, we're just going to put our stop loss right to this high and our take profit aiming for the previous day low. And this is a pretty simple trade if you're just going to trade it right from the market open of the 0 AM candle. This is going to be your go-to time. Go to 0 AM UTC standard time. This is going to be your main time that you're going to trade. Now we can even extend our take profit to the relative equal lows because it's just so close onto it. So let's see how this is going to play out, and that's a straight take profit. Now this was a very high probability trade, and it's very easy to trade it like this because most of the times this will actually be a take profit hit. Now let's skip on to the next day and see if the next candle is going to give us some kind of reaction that we would like to look out for. Yes, as you can see, we have actually traded higher, and what else can you spot? Two swing highs, which are relatively equal close to each other. Now this does already count as established movement onto the upside, because this candle alone has taken out its previous candle and even almost the second previous candle, which is just a little bit higher than the current one that we have right now. So from here on, we're just going to skip and see if we get more price action that we would like to trade on the daily chart. So from here on, I'm actually going to keep the pace up a little bit faster. So are we going for the previous day high or for the previous day low? Man, you can't really tell. Simply because this candle is just looking weird on its own. Now in this candle you can't already tell. The reason for that is because probably we are going to go for the previous candle low, and also these are relative equal lows. So we're just going to drop down onto the 4-hour time frame and look out for more information. Now what else can we all spot? Now there's going to be more advanced stuff that I'm going to explain in this entire backtesting session that I have not touched up on in this masterclass. But basically what we currently have is order flow. Now order flow is when you have an FVG that we have traded into and then lower. So we have an FVG in here, traded into it, lower. So essentially, as a quick example, when you're trading lower, then you have some kind of FVG, trade into it, lower. Some kind of FVG, trade into it, lower. This of course also goes for the upside. So when you're trading higher, you have an FVG in here, trading into the FVG, trading higher. Creating FVGs along the way, trading into it, higher. This is basically order flow. So also, now some people also might just call it that this is just basically an uptrend and downtrend, but this is not the same, because it's actually confirming to you that we are going into a certain direction and not just trading blindly out of feeling. So from here on onto the 4-hour chart, what can we spot? You can already see that we have a bunch of order flow signs that we are actually going lower and lower. We have this FVG traded into it, lower. Now we also have of course FVGs to the upside, but there's a major difference. This FVG has not been respected. We have traded into the FVG and completely disrespected it, traded lower. Now we have created another FVG in here, also completely disrespected it. So what is that telling us? That's telling us that right now we are going into the downside. Even though this looks obvious to you that, okay, we're making lower lows and lower highs, but order flow is more than just that. It's going to confirm you that the trend is actually going to stick to the original buys, which is basically just trading lower. So as you can see, we have another FVG traded into it. And very recently, what can you spot? And what else can you spot? We have another FVG which we have traded into. What is going to happen? Probably lower. But remember guys, I've also told you that you always want to look out for both sides of the markets. You don't just want to go blindly onto the chart and look out for things that are speaking for the trade. You always want to have an unbiased opinion on where the price is actually going to go. So you want to look out for both reasons on why the price can also go into the opposite direction, which in this case are going to be the relative equal highs. Now as you can see, we have relative equal highs on the chart, which is actually speaking against the trade to trade lower. Even though we have identified that we will go for the previous day low and also for these relative equal lows, we still have something that is speaking against the trade, and that is very important. The reason why I'm touching up on this so much is because if you're just going to trade the concepts on their own just like that, then it will not work. But this is essentially it, and we're going to drop down onto the 1 hour time frame. From here, what can we spot? We have this entire FVG that we have marked out, still the relative equal highs, and sometimes there's really not just much to say on a specific time frame. In this case, there was a lot of information that is already enough for us to take a trade, and on the 1 hour there's not really much that we can build off a trade from. So what we're going to do is aim for the previous day low. We're not going to aim for the relative equal highs, and our stop loss is going to aim for some kind of high that we can spot onto the chart. For example, I can see this entire high being close to 50 pips, so we're just going to take this one. From here on, we're just going to take the trade as always. Now let's see how this is going to play out, and we've actually traded into a take profit. Now this is going to happen a lot of the times where price just didn't really do anything and did not go into your drawdown for, let's just say, a couple of hours or even very close to your drawdown, right? But you have to remind yourself that you're not going to take a stop loss which is looking something like this. If you're going to do this just because you wanted to have a higher risk reward, then you'll just lose and the strategy will not work. So you have to stick to the actual analysis and always remind yourself, don't overcomplicate it and don't shoot for unimaginable profit targets. It is very important, guys. So we're going to remove everything, go onto the daily chart and look out for the same thing over and over again. We're going to skip onto the next daily candle. In this case, we have already taken out the previous day low. What else can we spot? We have these entire relative equal lows which we have taken out. So this is not a confluence anymore. because once relative equal lows has been taken out, then there's nothing that we really want to worry about anymore. Now, the next thing is also where we're not going to take a trade is because we have already taken out the previous day low. So there's also one more confluence that is just flushed down the toilet. So we're just going to skip on to the next day and see what that is going to give us. Now in here, we already have something quite significant. We've established movement onto the downside. Now keep in mind, this on its own was already established movement onto the downside, but we had a couple of problems where we're not going to take a trade. This trade is actually looking different. We are still trading lower, and in this case we have not taken out the previous day low. So where are we most likely to go? To the previous day high or for the previous day low? Of course it's going to be the previous day low. So from here on, we're just going to drop down onto the 4-hour time frame and look out for more reasons on why the price should actually continue lower. Now what have we said earlier? Order flow is already bearish. You don't want to do the analysis all over again because nothing's going to change that much onto the 4-hour time frame unless you're just going to skip months and months of price action. But in this case, this just very recently has recently happened. Order flow is looking bearish. Okay, that is already fine for us. Now what else can we spot? We have an entire FVG. That is something that is being against our trade idea, because as I've said previously, we like to trade into these FVGs and not away from them. But in this case, the previous day low is very strong. I also like the established movement. That's where we're still going to take the trade. So this is another thing. You have to weight the confluences. If you're not going to weight the confluences, then it's also not going to work. So as an example, you can have 10 different reasons on why you're going to take a trade. And let's just say you have 2 where you're not going to take the trade. Now you might be saying, well, I am going to take the direction where we have 10 reasons to take the trade, and I'm not going to take the position where we have 2 reasons. Now, this is not just as easy as it looks on the surface, because those 2 reasons could hold so much weight that you're not going to take the trade even though you have 10 reasons, because 2 reasons that is not speaking for your trade can already be so significant that it doesn't even matter. You could even be having 15 confirmations, but if you have 2 things that are heavily speaking against your trade, then you're not going to take it. Now as an example, so let's just say you have an FVG in here, also relative equal highs in here, and then the price is just looking something like this, right? You have relative equal highs, taken out liquidity lower, and now you're just trading higher. So now you even have established movement onto the upside, relative equal highs, and FVG, and let's just say the previous day high is also lining up. Basically everything that you can ask for in a trade. But here's the thing. Let's just say that on the bigger picture, this was looking something like this. So an entire downtrend. So although it looks very good that you just want to long this, right? So basically trade it like so, trade onto the upside, big stop loss. It looks very good, right? On its own, this is actually a very good stop loss. On its own, this is actually a very good trade. Let's just also assume that you have the equilibrium, which we have not traded into yet. Once again, everything you could ask for in a trade, and still you're not going to take it. Why? Because the context is just going lower. So as you can see, we had about 5 different reasons to take the trade, but we only had 1 reason to not take the trade. So, but that 1 reason, simply because we are trading lower, is holding so much weight that we're not going to take a trade. Now this is why context matters so much. Now in this case, it is totally okay taking the trade, and we're just going to drop down onto the 1 hour time frame for more information. Now on the 1 hour time frame is just essentially looking the same with the previous day low, the FVG higher, and we also have this price action gap. Price action gaps act similarly to FVGs. You like to trade back into them. Now there's more specific things that I've touched on in other videos. Watch them also closely, and of course it's also mentioned in detail in my mentorship, but that's a different story for now. So from here on, as always guys, stay disciplined to the trade. You've done the analysis and just want to take the trade onto the downside. Simple as that. Now, as you can see, this will most certainly almost work every single day. I've told you earlier that this win rate has a 95% win rate, and it's most likely going to end up in a take profit every single time. So onto the daily chart once again, we have taken 2 trades, 2 of them were winners, and we're just going to skip on to the next day and see what this is going to give us. Now on this day, can you tell if we're going to go for the previous day high or for the previous day low? Of course, you can't really tell. You don't know if we're going to go for the previous day high or for the previous day low. Why? Because this is a 50-50 candle. Now, even if you are saying that, well, we are already closer to the previous day high, so we might as well just take a long in that sense. But then there is still some that is speaking against this opinion, because we have this entire established move onto the downside. So once again, there are just way too many reasons on why you should not take the trade. This is a very similar example which I've told you earlier. So from here on, we're just going to skip on to the next day and see what this is going to give us. Now, and this is already a different scenario. The reason for that is because we have established movement onto the upside, and yes, I already count that as established movement. If you're wondering why, because this entire candle is looking so big compared to the previous candle. So this is already established movement. What else can we spot? The regular question, are we going for the previous day high or for the previous day low? Of course, it's going to be for the high and not for the low. So what else can we also spot on the daily chart alone? We have an entire FVG in here, so that is another magnet why we should trade higher. But what else do we have? This is still not all. We have relative equal highs. So as you can see, this trade has quickly become a very high probability. Now, as always, you also want to check for the perimeter discount. Now, we have already traded into the equilibrium, so that is not a confirmation for us to take, and we're just going to remove it. Right? This is also a very important thing. Don't try to imagine confirmations and just say that, okay, well, it has just come into the equilibrium, that is still okay, and I count that as confirmation. No. If the trade has even just touched the equilibrium, it's over. This is not confirmation anymore. But luckily, we have so many reasons on why we should trade higher, so this was not the only thing that's speaking for the trade. So from here on, we're just going to drop down onto the 4-hour time frame. What else can we spot on a 4-hour time frame alone? We have another FVG within the daily FVG, so very strong. Relative equal highs as mentioned earlier, but more importantly, we have this entire FVG which we have traded into, and where are we going to continue from here on? Higher or lower? Now remember guys, I've told you that we like to trade into the FVGs, not away from them. But if we have already traded into them, then use them as support and resistance. Now in this case, it is going to be support. So from here on, you're just going to drop down onto the 1-hour time frame. Now, but there is one more problem that we have on the 1-hour chart that is holding us back from taking a trade. Now, first of all, if we're just going to draw the equilibrium, so basically the premium to discount, we can see that we have not traded into it. But what else is there alone? We also have this entire candle which has no wick, so most likely we would also like to trade back into it. So as you can see, we have all of these different reasons on why to take a trade. The relative equal highs, the FVG, and all of these different things. But this is still not going to be enough for us to take a trade, simply because we have two reasons on why not we're going to take a trade. And these are holding so much weight that it's not worth it taking a trade. So we have equilibrium and also the candle which has no wick and basically needs a wick a lot of the times. So we're not going to take these kinds of trades. I'm still going to include these kinds of analysis even though we're not going to take a trade, because this is still going to get you into my mind and understand how the strategy is working further. So as you can see, if we're just going to skip further, now I'm not saying that it's impossible that we will not trade higher or even continue an uptrend. This is still all very possible, but I'm showing you how to avoid the losing trades, even though I don't even know if it's going to be a losing trade or not. So from here on, let's see what is actually going to happen. So not looking well currently, but that is still no problem because our stop loss would have been way wider to begin with, probably even below these lows. So we would have not been stopped out for now, but let's just see how this is going. Now once again guys, even though this is going to be a stop loss hit, if we would have taken the trade, of course, you always want to stick to the analysis and stick to the plan that I'm giving you. Now, safe to say, this would have been a stop loss hit eventually, because we're just so close onto it. I don't think that price would really just going to stop here and reverse all the way higher. And this is exactly why I'm showing these analysis. You have to avoid these kinds of days. It's very important. Alright, so here we are at the charts. Now with this strategy, you want to always and every single day start at the daily chart. The next thing is also you want to set your time as UTC standard time. This is very important later on. From here on, we're just going to go with the analysis. So first of all, starting on to the daily chart at your CHF pair, where are we going? For the previous day high or for the previous day low? On this candle, we can't really tell because this is more of a 50-50 candle. I've said it in the past. If you don't have an obvious movement or an obvious candle where the price is going to go, then you're not going to take a trade. Now, arguably, you could be saying that we have established movement onto the upside here already. Yes, usually I would like to call that established movement. However, it's a different scenario because if we look at the overall trend, so basically the past 20 days, what has happened, we have traded onto the downside. So from here on, you're just basically gambling with the price action. So we're not going to take this trade, and we're just going to skip on to the next day and see what that will give us. This is already a different scenario because yes, we have established movement onto the upside with these candles. However, we have this entire candle which has traded lower. So we want to ask ourselves the simple question: will we go for the previous day low or for the previous day high? Now, probably for the previous day low, and there's a couple of reasons for that. Firstly, let's go over the counter arguments that will not speak for the trade, for basically trading lower. First of all, we have an entire relative equal high in here. So basically this high. Now you might be saying, why is this a relative equal high? Because on the 4-hour chart, this high in here will look something like this. So basically a swing high, and then eventually you'll get to this point. This is another high. Those are relative equal highs. This is basically the entire framework that is speaking against us. However, we have countless of reasons that are speaking for the trade. First of all, we have also relative equal lows. We have the daily low that we like to look into. We also have an FVG, and if you look even closer, what else do we have? We have an entire BPR range, so even stronger. This is a very high probability setup. I am going to remove a couple of lines so it doesn't get too messy. So from here on, we want to drop down onto the 4-hour time frame. Can we spot more information from the market in order to build off an entire framework off from? Now, first of all, we can see we have these relative equal highs, and I've told you previously that this high in here will be a swing high on the 4-hour chart. Now, this is just based off experience. So this is basically the only thing that is holding us back from taking a short. If we go onto the daily chart, once again, looking at the entire price action, we would more favor shorts simply because we are already going lower. So going onto the 4-hour chart again, basically the same story because there was already so much information on the daily chart. Relative equal lows, previous day low, and from here on we're just going to go onto the 1-hour chart. Now this is going to be our entry time frame. From this time frame, you always want to take your positions. So we have the relative equal highs, relative equal lows, previous day low. What else can we spot onto the 1-hour chart that can further maximize our profits? I can see that we have an FVG lower. Now this FVG is also a BPR range. I'm firstly always marking out the FVG and only then the entire BPR range. I'm going to remove a couple of things or else this will get way too messy. So we have the BPR range on the 4-hour. This is further suggesting to us that we can push our take profit even further. So from here on, we want to go to UTC standard time, 11 p.m. closure candle, because the opening candle is going to be the 0 a.m. candle. So basically the next candle. And from here on, we're going to determine our stop loss and take profit. Now I am going to go into the 4-hour time frame real quick, just get a little bit more price action that I can see into. First of all, we have these relative equal highs. Now, the relative equal highs are pretty far away and the framework is basically streaming to go to the downside. This is way too high of a stop loss, right? And this is too low of a stop loss. So you would like to go usually in the middle, so somewhere in between a 50 and a 40 pip stop loss. However, in this case, I always like to go for something that is on the chart so we have more of a logical reason on where we could push our stop loss basically. So from here on, we're not going to put it at this FVG, but right above the FVG candle body closure. This is going to ensure that we're almost going for a 50 pip stop loss, but also squeezing out a little bit of more profit. Now on the 1-hour chart, we're not going to push all the way lower into the BPR range, but we're going to push right above it. So this is going to ensure that our take profit will most likely get hit. From here on, before I have already told you that you only want to risk 1%. However, with this strategy, since the win rate is 95%, you can definitely go for 3% or even 4% risk depending on the prop firm or if you're trading a personal account. So we'll also do that and go for a 3% risk on this trade. So from here on, we want to let the trade play out. And this is another take profit. So let's observe the entire price action. What has happened? Now the take profit has been hit and I'm going to skip on to the next day. So I've just skipped on to the next day. So what has happened before? We have traded into the BPR and we have taken the take profit. Now in here it's very important. If you would have gotten lower, I've told you this before, if you will go lower, then probably your win rate will first of all be lowered. And second of all, the strategy might not even work anymore because this strategy is designed for you to trade the exact way that I'm showing you in this video and also the students in my mentorship. So from here on, we're going to remove everything that we have just thrown out. We go onto the daily chart and do the same stuff over and over again. So what can we spot? Are we going for the previous day high or previous day low? This is more of a tricky situation for more of the beginner traders with this strategy. They will be saying that, well, this is not a 50-50 candle because we're already trading higher. But this is wrong, simply because this candle is a 50-50 candle and we are looking to trade in this candle right in here. So this on the daily chart, as I've told you. So we cannot really tell if we're going for the upside or downside. Yes, this candle is already trading higher, but second of all, it doesn't have a wick to the downside. So might as well just create a wick to the downside, and only from there on it could have the potential to trade higher. We're not going to trade this day and we're going to skip on to the next one. So from here on, what can we see? We have traded onto the upside, and a lot of the hindsight, guys, will be, yes, I knew that it will go higher. Once again, we're only trading higher probability days and we don't really care about the hindsight. We only care about the live price action. Firstly, as always, previous day high, previous day low. Probably previous day high because we have a very big candle onto the upside. What else can we spot? We have these entire relative equal highs, but this is still not all, guys. On the daily chart, what else can you see? We have this entire price gap. So most likely we will also trade higher because we need to fill out the price gap with a body closure. If we are not doing that, then we can still trade onto the upside. So that is essentially it what we have for the daily chart, except that this FVG that we have traded earlier has been filled. So this is more of a protection point for us now. So now we will drop down onto the 4-hour time frame and look for additional information as always. So we had those relative equal highs that has not been violated yet, and also the gap. What else on the 4-hour? There's really not that much on the 4-hour chart, besides that we have this candle that has no wick onto the downside. So this is something that speaks against our trade, and also another candle looking like this. However, due to the framework, this is still a very great opportunity to basically long the market. So if we're going to go onto the 1-hour chart to get even more additional information, and we're also going to take the entry on this time frame, we want to look out for more things on why the price should go higher or lower. So we have relative equal lows and also a little FVG. I'm going to zoom in for everybody that is watching on the phone. We have an FVG in here. So most likely we can expect that the price will go in here and only then higher. Now, a lot of the times I've told you that you don't want to risk it not being filled into the trade. This doesn't have anything to do with FOMO, but just to the nature of a low risk reward that most likely you will hit your take profit. But you need to get filled into the trade before that is going to happen. So from here on, what do we want to do? Usually we would like to take a trade just right from here on. However, in this case, we're going to do it differently. Our entry is going to sit right at the relative lows. Our take profit could potentially be the previous day high. However, this is way too much pip movement. As you can see, this is 40 pips and we're not trading this high of amount of a take profit. Now, first of all, I would like to determine the stop loss because this is going to give us an easier time determining the take profit. As a general thing, determine the stop loss and after that, determine the take profit. It's going to save you a lot of time. So from here on, where can we put our stop loss? If we are going to put it at 50 pips, it will be right below this low, but it's going to be firstly more than 50 pips. And secondly, I don't even think that we have to go in here. We have said on the daily chart previously that this low is protected by the daily FVG or daily BPR range that I've shown you previously. So most likely, this is not going to be taken out. And also this aligns pretty well with the BPR on the 1-hour chart. So from here on, this is going to be our stop loss. Now we can determine our take profit. Our take profit, what can we see on the daily chart? We have an FVG in here. And you might be saying, well, an FVG is quite well. We like to see that. However, what else can you see within this entire FVG? There's a BPR range that is extended to large amounts. So a very, very big imbalance into the market. So we're going to put our take profit right at this BPR range. And this will most likely be another take profit hit because this is a very strong signal onto the upside. So if we're going to trade into the previous day high, before trading into our entry, then trade is going to be canceled. From here on, we're going to let the trade play out and see what happens. You always want to stick to the analysis. Even if the trade goes lower, don't move your stop loss, stick to the analysis, guys. This is very important. And this is not a take profit hit. Now you might be saying, wow, we have gone into drawdown. What is this kind of strategy? This is the point of the strategy, that you have to allow the price to go into a drawdown. This is exactly what you want to do with this strategy. And if not, then you will not have a 95% win rate. So we have gone into quite a bit of drawdown. First of all, let's measure the pip movement from the swing low all the way to the stop loss. This is 4.5 pips. So spread is definitely not going to take you out unless you're trading on the prop firm which is called Maven, then you will be stopped out because this is the worst prop firm that has ever existed. If you're trading on a normal prop firm or even on a personal account, this will not get you stopped out. So this is very good. So it's safe to say that this was another take profit hit. Even if it was close, something like this would also happen if you're trading a positive risk to reward, which once again will not have such a high win rate. So we're going to go into the daily chart and do our regular things as always. I'm going to skip on to the next candle, and from here on, are we going for the previous day high or previous day low? This is basically a no-brainer, and in these cases, I would like you to drop down or drop up to the weekly chart, because the weekly chart is going to tell us more information if we have this sudden of a price action move onto the upside. So what can we spot? I can already see we have relative equal highs combined with an FVG, this very strong signal that most likely we will revisit this kind of area. What else can we see? This entire price action has not traded into an equilibrium, and we need to trade into the center between basically the premium and the discount. Before that is not going to happen, probably we will not continue lower. So this low will most likely not be taken out before we are going to reach into the equilibrium in here. So this is already giving us a sense of direction and a sense of protection. I am going to remove a couple of things. So we're going to go into the daily chart from here on. What can we spot? We have daily candle in here and the previous day low. Where's it more likely to go? Of course, for the previous day high and not for the low. So from here on, we're going to drop down to the 4-hour time frame because there wasn't really much more onto the daily chart. What can we spot? We have a massive FVG that probably will also be traded back into. So remember what we did on the weekly chart, where we marked out the premium to discount in order to know where the price is going to go next. However, this also counts for this time frame, so you don't neglect that and also don't forget that. Firstly, this FVG will get traded back into. Out of experience, big FVGs like that are not just staying open in the Forex markets. Now that might happen on futures, and other instruments, but on Forex, this is very rare that these kinds of FVGs are not going to get filled or traded back into. So in this case, I would not like to take a position that's looking something like this, because most likely we will trade into the FVG again and only then to go to the upside. So although this looks like a no-brainer to trade, I am not going to take this trade, and rather we're going to wait for the next day. So I've skipped the entire day. We have not traded back into the FVG, but this will still matter to us. So even though this has not happened, we are still looking for this entire price action move to be traded back into. Now, depending on what the daily and weekly is going to look like. So we're going to drop down onto the weekly time frame and look for more information. So we have traded into the relative equal highs. That is already good. We are on the daily chart, and the previous day high has already been taken out. So this day doesn't matter too much anymore. We're going to skip on to the next daily candle. And this is something that we really like to see. We have taken out the liquidity from the relative equal highs in here. We have movement onto the downside, and we have, so I'm going to go on to the 4-hour time frame. We have a lot of unfinished business onto this time frame. We have this massive FVG has not been traded into. Another massive FVG has also not traded into. We have the premium to discount range has also not traded back into. A lot of reasons to go to the downside. Now, a lot of people will be saying, well, but we are going higher onto the daily chart. Yes, we are going higher onto the daily chart, but look at the very recent price action. What has recently happened? And also, as always, are we going for the previous day low or previous day high? Of course, it's going to be for the previous day low. So I'm going to go to the 4-hour time frame. And what else can we spot? We have relative equal lows. On the 1-hour chart, this will be a swing low. So we have even more reasons to go into the downside. From here on, I'm just going to go into the 1-hour time frame. And we're going to go to UTC Standard Time, 11 p.m. And we're just going to take a trade as it is. Now the stop loss doesn't have to be 50 pips. Stop loss can be right above this high. And your take profit could potentially even be the relative equal lows. However, most likely we're not going to push it all the way lower, depending on how it's going to look like on the 1-hour chart. Now I can also spot even more relative equal lows on here. It's pretty safe to say that we will trade lower. So I am going to go for this low. And from here on, as always, guys, we just want to take the trade. 3% risk, market order, right at the 0 a.m. candle. And let's see what price is going to give us. So that's another take profit hit. Simply because we have identified what is going on onto the daily chart. We have looked into the weekly chart and even more price action to build a trade from. So as you can see, you can predict the price pretty well with this strategy. Even if you are going to go into a drawdown, this is still no problem. This is the point of having a lower risk to reward. You cannot predict it every single time by 100%. But even if you are just right 95% of the time like me and also the students in my mentorship, then most likely this will be very easy work for you. Now we will go over more example in this video, but I just wanted to show you that this is not just hindsight or anything like that where we're just backtesting and of course we're winning. Actual students have taken the trades with me or even the individual trades that they have taken on their own and they are making a lot of money. See, this student has made his entire money back within not even being 1 week in my mentorship. So from here on, as always, we want to remove everything because that doesn't matter too much anymore. I am going to leave the relative equal highs in here. And we want to ask ourselves this simple question. Previous day high, previous day low. This candle we have already traded, so we have to skip on to the next candle. And from here on, it's the same question. Previous day high, previous day low. I can't really tell. If you are going to ask me, then we need to go on to the downside at some point again, because this is too big of an FVG to just stay like that. However, since we don't know, we're just going to skip the candle. So from here on, once again, this is a 50-50 candle. I can't tell. So we're going to skip forward. So this candle has taken out a significant amount of previous day highs and also the relative equal highs once again if you want it like that. However, this once again doesn't matter too much because this candle is once again a 50-50 candle as I like to call it. So next day and we're going to see what we're going to get. So we have gotten 2 candles because this is from Friday all the way to Monday. And in here we've already taken out the previous day low, so we can tell next day open. It's simple as that, it's mechanical, and it's the same stuff every single day, guys. So in here, previous day low or previous day high. Most likely previous day low. We have already established movement onto the upside with these candles. We have probably unfinished business onto the 4-hour time frame, and also this daily candle has no wick onto the downside. So we go onto the 4-hour time frame and look for more reasons on why we should go lower. First things first, we have already traded into the equilibrium of this entire price range. So this as a confirmation does not matter anymore. However, what else can we spot? We have one more reason that is speaking against our trade idea because we have this FVG, which most likely there's a fair chance that we will return into this FVG at some point. So this is more of a 50-50 trade, and I would like to go into the 1 hour and see if we're going to get more confirmation to trade lower, and if not, then we're just not going to take a trade. So what can we see on the 1 hour chart? We have relative equal highs as usual. So most likely we want to trade onto the upside, and this entire FVG does not look like to me that we're not going to revisit it. So this once again is one of those trades where it is looking pretty fine on the daily chart, but we're not going to take the trade simply because we have not gotten the confirmation that we would like to have on the 4-hour chart. Now, if you have questions, leave them down below in the comment section. Now, of course, I cannot respond to every single of those comments because I have also students that have a priority to me. So that's why I cannot answer every single question of you, but feel free to question them down below. So from here on, we're going to skip on to the next candle. And as you can see, we have not gotten the confirmation. If you would have traded this lower, this would have been 100% a stop loss hit. Simply because you need to identify these kinds of things earlier, and it's very important. Now, another thing that I've also not mentioned is that we have an entire price gap in here. And as I've told you previously, we like to trade back into the price gaps. So what can we spot in this kind of price action? Are we going for the previous day high or for the previous day low? Now, this is probably going to be a very good probability trade. Now, although we are sitting currently in an FVG, which is not good because usually these can act as support and resistance, so we'll go in here and then lower. However, given the current circumstances that we have already traded higher, and most likely this can also just be a pullback, we're going to go into the 4-hour chart, and it's worth actually looking into more information. On the 4-hour chart, what can we spot? Firstly, we had an FVG, have traded into it, and have traded higher. So this basically, the order flow is turning to go to the upside. What else can we spot? We have an entire price gap in here. So as we have just seen on the daily chart, these price gaps like to be traded back into. This is basically telling us that there is reasons to go on to the upside, but I just want to see a little bit of more confirmation on the 1 hour chart as always. So this is basically your entire plan for every single trading day. Daily, 4 hour, 1 hour, and occasionally the weekly chart. So from here on, what do we want to see? We would like to see some kind of relative equal high. In this case, the only thing that I could classify as relative equal highs is this entire price action move. However, they don't matter too much because this is on the 1 hour chart, and you would ideally like to see it on the 4 hour chart. This is still just additional information and also confirmation for us. What else can we spot? We have this entire FVG, which we have traded into, and these candles have no wick onto the downside. So this is straight up going to be our entry. So the take profit will be 10 pips. However, it's pretty likely that we'll actually reach into the previous day high. So Our stop loss can be 50 pips, or if we're going to put it right below the previous day low, then most likely this will be way more than 50 pips, so we're not going to put it there. Now also we have these relative equal lows, and relative equal lows are speaking against our trade idea because we want to trade onto the upside. So we're going to give it a little bit more room, even if we're trading into the relative equal lows, so that we have still room to go onto the upside, because this is our last point of protection. From here on, as always guys, take the position as it is, 3% risk, market order, or in this case it's a limit order, and let's see. Now if the trade would have gone into the take profit before we're going to get an entry, the trade is cancelled. So from here on, let's see, and that's another take profit hit guys. That's how easy it is if you just identified the markets over and over and over again, and actually look into the price action, because the price is not lying. The price is giving you information. Every single candle is a printed candle that is delivering something that the market has done beforehand. So as you can see, this strategy works like a charm, and it's actually profitable. Now in my mentorship, there's a lot of different students making not only their feedback within 1 week of being in my mentorship, but they're also just passing profit simply because it's just that easy to pass them with this strategy.